Good morning. Welcome to the Brew. It's Wednesday. I think Wednesday's Prince Spaghetti Day. But anyway, we're going to talk a little bit more about these risk graphs today after our session yesterday. So we're going to put it all together. We're going to look at Trade Hawk a little bit. Molly's probably got some good data for us in the market. So let's get rolling to the opening bell. Ding. Good morning.
Good morning.
We're back to our usual uniform. I like it.
If it's pasta day, I think we should use a lot of hands when we talk about things.
I always
today.
use my hands.
We'll go Italian.
Yeah, that's the Italian in me. I always use my hands.
And then let's make Bobby from Trader's Edge proud today because he's Italiano.
Yeah, he's really Italian, isn't he?
Yeah, proud.
Oh, yeah.
We are proud to have him aboard. Got to have one good Italian on the team.
Oh, that's today, by the way. Today's Wednesday, right? I think they're on later today.
Yeah.
Good. Okay. So, Mal, do you have anything for us today? This is you and me running a little behind today.
Yeah, we teased everyone a little bit with NVIDIA, but so this is the big reveal. So literally hot off the press. I just have a nutritional bar, so I'm just going to do hot off the press here.
Okay.
But hot off the press. So NVIDIA, from a bird's eye, from up close, actually, looks really great. So they're up to the 1 trillion mark, and they beat their quarter earnings reports, and they are just flying high, and they're doing a stock buyback, which is always good.
Mm-hmm.
But when you get into the weeds, and we're going to thank Max for this because he uncovered this sleuthy information. So the reason they beat some of their earnings was from a $2 billion chip purchase from a company called CoreWeave, and CoreWeave purchased 2.3 billion but when they've 2 billion in chips. But now this is interesting. So no one's really heard of CoreWeave because they weren't around 2 years ago.
Mm-hmm.
And another interesting thing is that NVIDIA, when they did a $2.3 billion, when they did a raise, NVIDIA was actually one of those donors. So they jumped in on that. So NVIDIA owns a piece of CoreWeave. So when they bought these chips, they bought 2.3 billion in these chips with debt collateralized by NVIDIA chips. So that would be like you go to a bank and you say, hey, I'm going to go buy this house, and by the way, they didn't put any money down because they didn't have any. So it's the same would be you go to a bank, you say, I'm going to buy this house. It's really great. I need it. They're like, how much money are you going to put down? Nothing. Okay, then what's going to be your collateral? Well, the house itself. So absolutely no bank would ever invest in you in that case, but the bank did on this. So the other interesting thing is that the shares that the CEO is unloading was 89,000 shares in options, so that he's liquid. So he then turned around immediately and is liquidating those. So
wait,
although
hold on. Question.
Was your head spinning?
Yeah, well, yeah, a little bit.
Was your hair blowing back?
He was awarded these 89,000 shares, and then he immediately turned around and sold them. Is that what you're saying?
Immediately.
I think what we're saying. Okay, go ahead. Sorry. I just want to make sure I understand.
So now he personally is unloading them as fast as he can. But now the company itself is doing a stock buyback. And so stock buybacks always increase the price of companies because, Buffett loves those. And when you do a stock buyback, it's signs that the execs think that's great. We want to, pull in ownership. And so now we're watching the CEO unload as fast as he can. So the reason that and just to touch base on what NVIDIA is, NVIDIA has these AI chips that are in all of these AI components around the world. So they are very important very important company. And so the reason, this is the takeaway, the reason they beat their projections on their quarterly earnings is because of this $2 billion chip purchase from a company that wasn't around 2 years ago, CoreWeave, that NVIDIA invested in. And this purchase was solely collateralized by the chip itself with no money down. So this is, it looks like a pump the stock up and dump the stocks while it's high.
Wow, you are such a conspiracy theorist.
I know. I'm just, it's news.
Jeez.
It's just news.
Officer Molly out there. Holy cow. Well, you realize that.
And by the way, thank you,
he can't
Max.
do that, right?
We've got a secret weapon in the back. We want to thank Max for that. That's all, Max.
Okay.
Yeah.
But you realize that unless he's really dumb, he can't really do that. He can't pump and dump. That puts him in jail. There's no way that's happened. He doesn't need to do this to have this kind of money. It's only, I mean, among friends, it's only $37 million. My gosh, what can you do with that?
Right. So listen to this. This could potentially, they're 15 times bigger than Enron. If this is true, and this is happening, this is bigger than Enron.
Jeez. Put your police hat on.
I know. This means lost. What this really means is, if this is happening, this means lost jobs for people that depend on this company.
I'm not going with it. I'm not believing.
All right.
I'm saying, I'm calling bullshit on that one.
Okay. All right. Go do your research. Look it up.
All right. Now we're going to remember where we stand. You're the conspiracy theorist. I'm the opposite on this one.
Your cognitive dissonance. Your cognitive dissonance. I'm conspiracy theorist.
All right. Yeah. You know, we should look up. Let's make a note of this. Let's look up his monthly selling of shares. And again, we talked about this yesterday, I think. It's what is it called? We're going to look that up too. So the SEC rule. So I'm typing right now. What is the SEC rule for selling insider shares, right? I might not get this. Shares regularly. So he could be in that program too, right?
Right.
But I know what you're saying. He got these. He's awarded these shares. He immediately turned around and sold them. I mean, look at, owning big yachts is expensive. He might have needed some funds to.
Yeah, that's okay. We're good with that part.
We're good with that.
The CoreWeave piece is a little sneaky.
Okay.
So we might want to take a look at that. And then when you look back at the unloading of stock in combination, it becomes a little bit, I get a little uncomfortable.
Okay. All right, Ma. I get it. All right, here, I found this. Ready? So insiders, they can be subject to the Rule 10B.
Oh, by the way, what is an insider?
Oh, well, an insider is someone who is, who's part of the company in some capacity. It doesn't necessarily have to mean that they're working a 40-hour work week or a 60-hour work week. It can be investors and that sort of thing. So they have inside knowledge of what's going on in the company. So having that inside knowledge, you therefore you're privy to certain things that could affect the stock price. In which case, if you know something, bueno's coming out, you could sell your shares. If you know something's horrible coming out, you could sell it before that. So the insider law prevents you from doing that. Okay? So you're not allowed to do that. Unless you're a member of Congress, then you can do it all the time. So you're allowed to do that, which is insanity to me.
Who's the conspiracy theorist? Who's the conspiracy theorist?
Oh my God.
I don't believe they do that. I don't believe it.
I believe it. It happens.
Congressmen are good. They don't get sneaky.
How do you think crazy Nancy out on the left coast figured that out? Right. It's amazing. Her stock picking is better than any financial planner. It's unbelievable. Anyway,
I know it's uncanny.
Shan't we go there? So anyway, it's a Rule 10B 5-1. It's of the Securities Exchange Act of 1934. Blah blah blah, and it is in place. So insiders can sell their company stock under a prearranged trading plan. Okay. So what that means is they pick a number of shares and they sell that consistently each month. Right.
And what's does it say what the leeway you need to give
yeah,
people?
so let's see. The trading plan must specify the amount, price, and dates of the proposed sales.
But how far in advance do you have to notify the world?
Doesn't say that yet.
So on that
I'm reading fast
note,
too.
yeah, if CoreWeave was created 2 years ago, and if that, statute is under a year, well, then that seems like you could dot your I's and still
Right.
be legal in the sense of unloading with that CoreWeave play.
Yeah. I mean, there are, I guarantee you there are rules that you have to submit, right? And once you submit them, it's consistent for the rest of the time. So you always sell these shares, and you're going to have inside information that's both bearish and bullish for the company per se, right? So you're still selling them even in the downtime. You just keep selling them. So you adopt that plan. And with, look at most of these really, really wealthy executives, it's a way to have some liquidity.
I'm just gonna throw a wrench in the whole thing. I'm just gonna a cherry on top. So CoreWeave is a tech company, but it is run by hedge fund guys.
Okay.
With nothing to do with tech. Point being is that this might just be a shell to do that $2 billion purchase to up the earnings.
Jeez, are you?
Why don't we have tech guys?
When you're walking around the house, are you looking in the outlets to see if someone's looking at you or listening?
I literally have. Yeah, I have a belay trap so no one can belay off my roof. No, I'm kidding.
All right, Mal.
It's these marshmallows. They poison my brain.
Apparently. Jeez, take those things out. My God. Okay, so Rule 10B 5-1. This gentleman, what's his name, by the way? Huang? Is that sound right?
Yeah.
Yeah. So I think the suspicious part, at least in your terms, is that he just dumped that gift of 89,000 shares right away.
That's a lot.
It's a lot, but you know what?
With
relative to what he owns, how many shares does he own?
Yeah. That's a great question. I want to say that's a really good. I'm going to look that up right now.
I bet you it's it's bigger than a bread box.
Yeah. it's bigger than the West Wing that he wanted to build on his house.
Yeah, I think like someone like, what's his name? Elon Musk. He does this every month. He sells shares, right? He owns 86 million shares of Nvidia.
Okay, there you go.
And it's only about 4%, just under 4% of the company's outstanding shares.
Okay.
And Elon, I think, owns a bigger percentage than this of Tesla, and he has I want to say 411 million shares.
Right. And he's unloading. Is he unloading those to pay for X payments?
He did that already. He sold a bunch for that. Yeah. And then he probably is one of these 10B rules as well. He's selling a certain amount of shares to live his lifestyle, pay for Twitter. Can I still call it Twitter? The X is dumb to me. I mean, maybe I'm gonna regret it, but I still like Twitter. I don't know.
Don't ask the conspiracy theorists. Don't ask the conspiracy theorists if you can still call it Twitter.
And that's China spying on us. That's it. All right. Okay, so back to our continuing education after all this banter.
Right.
So we've talked about just the basics. What is a call? What is a put? Right? What is an option, etc. Yesterday we talked about some risk graphs. I call them risk graphs. Someone else has called them I forget the name of it now. Well, anyway, risk graph. Okay. So we've talked about that. We talked about the difference between selling calls and buying puts, selling calls, both in the same bucket of bearishness and bullishness, right? And then we're going to talk about spreads today a little bit, but I want to go back to the risk graph, and I'm going to share my screen and talk about how these things combine. So it'll kind of bleed into combining options into spreads and what the graphs look like. And then we're going to look at how to read these things, okay? So let's go to the screen. Again, this is 103, options 103. You start at 101. I don't know where we're going to end, and we're making this up as we go. We're going to end on 600 somewhere.
To the moon.
That's right.
To talk Reddit. To the moon. We're going to the moon.
Going to the moon. Okay, so I put in 3 different trades into the TradeHawk risk analysis tool, which is what we call what if. Okay, and what if just means what if it did this, what if it did that, blah blah blah.
And
Okay.
Lex, just quick
Yep.
question: do you
Yeah.
have a program risk management for life in general, metaphorically?
Wait, I don't understand that. So, what do you mean by
So
that?
can I put life scenarios in here? I mean, this is great for trading stocks, but what about personal life experiences
Yeah,
and
you could do
analysis of
it.
risk?
You could put in the strategy tracker in there and just write
Okay.
notes to yourself, right?
All
Don't
right.
be such a conspiracy theorist. You can do that.
Okay.
um, okay, so I did 3 different trades. Now, the reason I chose these trades, a long straddle, and again, we'll get into depth on each one of these in future episodes. A long straddle, okay? Straddles are the same call and same put. You're either purchasing both or you're selling both, okay? And it's the same strike. So just so we're clear. So in the long straddle here, I'm just going to build one here. Let me clear this
And
out. Yep.
conversely, a strangle is what compared to a straddle?
Strangle, when we have one of those too. So a strangle is buying a call, buying a put, different strikes, same month.
Okay.
Okay. Now we'll show one of those as well. And then where you place your call and your put in a strangle, that's a personal decision you make, and you may have some math behind it, but there's no rhyme or reason other than the fact that you might be bearish or bullish and you'll lean one of the legs one way or the other. Okay. So that's doable. Straddles use the same strike. So if I were going to create a straddle in, what am I in here? NVIDIA. Look at that. You can see this orange line. That's the at the money. At the money means it's the strike that is closest to the current stock price. Stock price is around 419. So the closest we have in this particular month is 420. So that's why it's illuminated this TradeHawk orange across the screen. Okay.
Okay.
And
And
I would
just point
say,
out.
yep.
Oh yeah. Just
Go
point
ahead.
out in the money and out of the money
Yeah.
versus out of the
So
money.
if I had a drawing tool, okay. Wait, that's a cut. Did you notice that was a cut? Hold on. Maybe I do have a drawing tool. Hold on. Let me try this. Oh, it doesn't work.
Oh.
Oh no, hold on. I want to try it again. Oh my goodness, it doesn't work. All right, I thought I was going to get it to work.
We'll
It's
get
not
there,
working.
folks. We're working on it.
We're working on it. Oh, I know how. Oh my God. Did you see that? Did it work? Oh, it was on my screen. Anyway, so what was I talking about? Oh, straddle. Straddles you typically do at the money. And Molly asked about in the money. So in the money for calls are strikes, right? Here's strikes that are less than the current stock price. You can see they're illuminated this or shaded this, I don't know, greenish color. See it here?
Yeah.
Okay. Puts are the opposite. In the money puts, the strike price is higher than the current price. So you can see how that is shaded. So I've highlighted my in the money options with the shading feature. Okay. And then the normal color here up above are the out of the money ones. And then the band in the middle signifies at them. It's very easy to understand once you know what you're looking at, right? So straddles we typically do at the money. You don't always have to do them at the money, but typically that's where you do them. So to construct a straddle, I'll just do a long straddle. That means I'm going to buy both call and put. So if I did that, I'd buy the call. I'd buy the put. You can see how easy this is in this platform. I've got a long straddle in NVIDIA. I'll send it over to what if here, okay, which I've already done. And then what it does is it comes over here and it looks like this, okay? Now, remember from our talk yesterday, we had a long call graph. Remember it looked like that? So this payoff is right here, what I've paid for this call. And you can see over here, it's 1627. Okay. So that's $1,627. And there's probably some, fractions after that. If you look here over in the corner to the left, you can see 1627. That's the most I can lose. Remember, we talked about long things. You can lose what you pay for them. Okay. So that's what I can lose on this call. And that's a call graph. Okay. So let's do a put graph. I can hit that button, right? Okay. Now a put graph, remember, goes the opposite. It's the hockey stick in reverse. My put graph is 1588. I bet you if I get over that thing, it's going to be 1588 over on the left side, which it is. Okay, so that's my max loss. When you combine these two graphs, okay, now all of a sudden you're adding that $16 number to this $15 number, and we should have a much bigger maximum loss. So watch the graph. You're going to combine a call graph, hockey stick to the upside, to the right, put graph, hockey stick to the left side. So it should look like this when we're done, okay? A big swooper. So let's see what happens when I add the call back in. Oh, shocker, right? So, and when you get here to your negative number, and again, I'm not hitting it exactly right, it's the sum of 1627 and 1588, which is the price of our two options. That's our max loss, okay? And we lose that at the strike that we did it. In this case, it was 245. Is that right? Yeah, Tesla, 245. So that's where we lose the most money, okay? And I think if we have a little dollar thing up here, there's the exact number, and there's the max loss. Just like I said, 245, you lose the sum of those two numbers, which happens to be 32.15, okay? And again, in TradeHawk, it's really easy, especially if you know the clicks. Everything's right in front of your face, so you can't mess it. So that's how you read these things.
And just a question on TradeHawk. So if someone wanted to get in touch with you, are they able to?
Well,
about TradeHawk.
They should send me an email at tradehawk@tradier.com. Maybe if there's a banner guy back there somewhere, we can do a banner, tradehawk@tradier.com.
Okay, done. We're going to work on that. See if we can get that going now.
So that's how you do that. And what's nice about this too is you can take a component out, right, and see the graph of the single leg. Okay, and again, it's really important to understand what these things do. Now let's look at a strangle. Any idea what a strangle is going to look like? Is it going to look like this a little bit? You can make them. You can guess, Mal. It's okay.
Oh, me. Oh, okay.
Yeah. Well, who else is here? Who else am I calling?
I think it's going to look like this. It's going to look like that.
What is that? That looks like a pizza pie.
I'm strangling. I'm strangling something.
Okay. Let's do it. Okay. All right. So the one I picked was a 390 put. Okay. So that's $30 out of the money. And I picked, so let's go $30 out of the money for the call, which 420 plus 30 is 450. Okay, so there's the strangle. So look at, here's what I said. It doesn't have to be perfectly uniform, your two legs. Okay, and again, you could lean it based on whether you're bearish or bullish for the strangle. Okay, and again, you could sell these, you can invert them and sell them. Definitely a different risk profile. But what's going to happen here now is that now your break evens are somewhere else, right? Because you have all this space in between 390 and 350 for the stock to have to move to start being profitable, plus whatever you pay for this thing, right?
And just a quick summary on what a break even is.
So break even, good question. So break even is where your strategy, in this case, this spread, crosses the zero line of profitability. Okay, so that's your break even points, and we will show break evens in here in TradeHawk. So I think it's in preview, if I'm not mistaken. Let's see what happens. And again, I've been having a little slowness. Hang on, I'm not sure it's going to show. Give me a second. They're not getting a quote for this, but I'll show it on here. Okay, so here, and I sent it here already to the what if. So what has to happen now is I've got $1,905 in this trade. Okay, that's what I paid for it. Remember, when you own these things, that's what you can lose, what you pay for it. That's what I can lose. Where do I lose that? Well, I lose it maximum between 390 and 450, as I said. Those are my strikes. So if the stock ends up there, and again, we're looking at an expiration graph, and I should probably explain that. There's two graphs on the screen. Okay, if you look at the legend over here, the green graph is today. Okay, it's this trade today, and it's a lot more. This curve is a lot smoother. Okay, the yellow graph is expiration. The reason the yellow graph is so angular is because time has all gone out, all the premiums decayed, trade's over. So that's what things look like at expiration.
You mean theta? You mean theta?
Did I say that? I said theta. You're right, because of theta. Now you can imagine if I flip this over and we're short this, it would look just the opposite. So I'd want it to stay in between the lines, the strikes, and my profit would be up above. And how much can we make on a short credit spread? We can make what we sell it for. So this 1905, it would come up here and be up here, and the legs would come down if I were short it, and that distance would be 1905 between the zero line and my max profit. Okay?
Okay.
Makes sense?
Getting there.
Sort of?
Yeah, no, this is great.
Okay. So look what we have here where our break evens are. So it's
and just to ground it down into reality, when would you use this strategy? So when do I
yeah.
pull this out of my
So
my
if
armory?
I'm buying this strangle, which I typically don't do unless there's a short involved, but if I were, implied volatility, okay, which is the option premium levels, would have to be really, really low, okay, and
Okay.
really cheap to buy. If it's super expensive, I'm probably selling this stuff, okay. When it's really low, even when it's really low, I'm still hesitant to buy premium without selling something else against it to offset the long premium because of what? Theta. It's like, my analogy with theta is if you're long it, it's like getting in your favorite ski outfit and jumping in a pool of hot water and trying to tread water in it with everything on you. It gets heavy after a while and it's like
Yeah.
starts bogging you down. That's what I think of theta. It's just try to tread and keep your head above water and you try to scalp the heck out of it. Conversely, the other way, when you're short it, you have problems and you fall off cliffs every once in a while, right? Which
Yeah.
is kind of scary too. You better have a rope like you're climbing.
Right. And this goes to your plan and having a trading plan. So,
Yep.
and to know yourself, know what your parameters are, and to stay within those rails.
Yep. Yep, exactly right. So I hope this makes sense how we're reading this. Maximum loss, the sum of the legs in the strangle, and then the other one was a straddle. That's my max loss. Understanding where it occurs, okay, on this thing is also important. It's what you pay for it plus the strikes or plus or minus the strikes, right? In the case of a strangle, you have two strikes, so it's going to be way down. It's at $19.05, way down from that bottom strike. So that's where you break even because you got that heaviness of owning this thing for 19 bucks. So right around 370 and the upside looks like right around 470 is your break even. So think about the move this thing has to do between 370 and 470 for this to start paying off. Now, that's at expiration. That's the yellow line. You could have movement in between and this thing could get more expensive as the move happens before expiration, right? Because people don't know. This could move $100, it could move no dollars. You just don't know. So that's why this green graph looks like this. So you could have profitability in between here if you get moves before expiration, in which case you could unwind this thing and take it off and take your profit, right? So that could also happen, right? So it's important to understand the difference between the two graphs.
And that's what my next question was. So what does management of this looks like as you approach expiration? So what are some things that could possibly happen and what are some moves you could make?
So, the way the pros would trade something like this typically is when you're long options like this, it's also going to give you the ability to be long gamma. Okay, and I don't want to get into gamma yet because it's a whole nother episode when we go to Greeks next week. But gamma means you're getting long gamma means you're getting longer as the stock goes up, shorter as the stock goes down. So what pros might do is they might, as you get shorter and shorter, they might buy some stock down in here because they're getting shorter. And it's just called gamma scalping. And then as it goes back up, if it goes back up, they might sell it, when it gets to another point. So they're scalping the stock, hopefully positively, to offset the theta in this trade. And that's how pros would trade this, right? Now, as a retail person, you might say, I think I'm going to get a move. I'm going to put it on today. I think within a week, I'm going to get a move, which is an expiration. It's got 30-ish days to go. And I hope I get that move. And if I do, then, I might take it off here and make a little money, a couple $1,000s in this case, right? So those are the kind of, that's certainly valid. You could certainly do that, right? It just depends on what your strategy is for these things. Most folks don't put these things on the long side and hold them to expiration because you're typically going to, lose that amount.
Right.
Okay. Cool.
And then, what expertise do you need to engage in this strategy? So can beginners do this, intermediate, advanced?
This is a pretty beginner strategy. It's just buying two
Okay.
options, either the same strike or different strikes, or selling them if you're going to do the opposite. The sell side, let me just make a note. The sell side is difficult because typically brokerages won't let you be short units. So what ends up happening is if you sell this, you're probably going to buy some other wings on the call and put side to protect infinity, right? And then all of a sudden you're into an iron condor. And again, we'll see that in another episode. Okay.
And
that's when those legs kind of pinch off on the bottoms. Go ahead.
And your favorite strategy is the butterfly, correct?
I love the butterfly. I also like the iron condor. It's a combination of the two. They're both great. I love them. Yeah,
And
very
Lex,
easy to work with, very simple. Yep.
Didn't you invent a new strategy last month?
I did?
Yep.
No, someone else did. We'll talk about that one too.
Okay.
I forget what they called it. It was I don't remember what it is. It's a exploding bull spread or something like that. We'll look at one of those too. There's so many of them. People make them up as they go. All right, what time is it? We got maybe a minute. I was going to go to synthetic long stock.
And just to recap, tomorrow you're doing a huge show on bonds, which is, do not miss that one. That's going to be an excellent one.
Yeah, James Bond.
Options Brew. Yeah,
yes.
Options Brew TV.
I'm going to wear my tuxedo for James Bond Day.
Are you really? I hope you do.
Might. I don't know. I might.
I hope you do.
I hate tying the bow tie though. So.
Get that clip on.
Let's do this real quick. I'm going to go fast. Okay, see the screen? Okay. All right, so we got a call and a put, right? What's the call graph look like? Bingo. Remember the hockey stick to the right. The put graph, it's a hockey stick. I got them short. I got a short one. Oh, it's not a good example. All right, I got a long and a short. So what I did here on this one, this is called synthetic long stock, okay? And synthetic long stock is when you buy a call, sell the same put, same month, same strike. So you got a long and a short. We call this synthetic long stock. See it down here? Synthetic long stock. So when you do it in TradeHawk, you do it right. It'll tell you the name of it. I sent it to What If, okay? It's over here now. It's this guy here. So it's a combination of being long the 420 strike. I'm sorry, the 245 strike in Tesla call. Short the same 245 strike, same month. Okay, or the put. Now, remember the graphs. Here is a long call graph. It's that hockey stick again. When you add in the short put, now this is the short put, remember. Okay. See the short put, you only make a defined amount to the upside and you lose a defined, infinite amount to the downside, always zero.
Right.
If you combine the two, you got the call working to your favor, the upside, right? But you're still losing on the call and the put to the downside. So this all of a sudden becomes what we call synthetic long stock. This behaves just like the underlying stock. If you were to own, in this case, I did how many? One. I did one. So that's 100 shares. So 100 shares of stock and this position are the same exact thing. Okay.
And then maybe in a show down the road, we can pull in margin on how that works.
We could do that. And this will tell you the margin on all this. I'm assuming it's the same as being long stock. I'm almost positive it is. So we will look at that. But what do you know? This is unbelievable. All right. So that's how you read those. That's how you read those graphs. It's really, look at when you get really and you get experience with this and you've done it for a while. I typically don't use the what if anymore because I know what all this stuff looks like. But as a beginner, man, I'll tell you, it's really good stuff to have. It's great stuff to practice on. I really encourage it. It's good to, you saw how I unchecked things up here. So you can uncheck things to see what the graph of the call looks like and you can recheck it, go back. And now you can see the combinations. It's great to mess with this when you're a beginner. It really is. This is how I learned, was playing around with one of these things. And we didn't really have this back when I started. We had to draw things on paper, but this is a real powerful tool, I'd say. So really work with that. When you get really good at it, you don't even look at that anymore. You got it down, you just go.
Right. And when you first start out, you're conscious on competence. So it's like tying your shoes is you have to think about every lace when you're a kid learning to tie your shoes.
Yeah,
and then
you don't do that anymore.
It's unconscious competence. And then you just tie your shoes or you drive somewhere and you don't know how you drove yourself. So just hang in there and you'll get it.
Hang in there. All right, Mal, I think we should probably shut her down. Tomorrow we got the guys. Molly's got her day off, and Jason and Mark are coming. We're doing the James Bond.
I will be right. That's a good one. Do not miss the James Bond episode. That'll be a great one.
Perfect. Good. Okay. So won't see you tomorrow, but Traders Workshop tomorrow, and you have a great day, and let's close her down.
All right. Bye, Lex.